talk a little bit more about change, I would like to introduce our last guest,
Right.
Josh Hamilton. Please welcome. Podcaster and author. These days you're writing a book about GameStop. Let's have a short introduction. Push the system a little bit back. During the pandemic, you made an interesting step onto Planet Finance.
Yes.
What did you do exactly?
So my entry into Planet Finance was in January 2021. And after basically a year of the pandemic, I started seeing the most unbelievable memes on Reddit, all about how people were just going to try and take down a hedge fund for fun. And decided that that was, at that time, probably the most entertaining thing I'd seen in like an entire year. So I spent days and days just like sifting through Reddit and trying to figure out what on earth was going on.
Yes, because what was going on? Because not everyone knows this. It was a random group of people around the world going for one stock from one particular company.
Yeah. Yeah, so basically what happened was one hedge fund in particular, but like a handful, decided that they would short sell GameStop. And then...
And that means that they no longer thought GameStop, this company, was going to grow. So they said, we want to get rid of our stocks, right?
Yeah, so basically it's like a bet against the company. It's
yes.
like going to say...
They thought it was going to fall down.
Yeah, like it's in the middle of the pandemic. There wasn't a lot of people going out and buying things, so they just decided, well, GameStop was one of many companies that got shorted heavily, but it was the one that, for whatever reason, everyone gathered around and just went, no, you know what? The financial system destroyed loads of companies that were, I don't know, to millennials like me, part of our childhood almost. Like we'd watched things like Blockbuster get destroyed by private equity. We'd watched in the UK Woolworths die. We'd watched Toys R Us get.
So you were angry.
Yeah, a little bit. I mean, it was sort of like we were sick of watching the financial system destroy companies, and I'm sure John will disagree with that, but. We were just sick of watching that happen, and people just gathered around this stock and thought, you know what, like we're done with this. Like, if we can all lend $100 or €100 to taking some sort of stand against this, then let's go for it. Let's do it.
And that meant literally that the company got money again, and the stock was going up, and they probably couldn't believe their eyes either.
No, the company went from about $500 million in debt to $1.7 billion in surplus capital in about the space of 6 months. They got a whole new chairman of the board. They brought in a whole bunch of executives from like a former Amazon, Google people, and they completely transformed the company around it. It was unbelievable to see. Like, and ultimately, the people on Reddit saved GameStop. Like, it was on the brink of being shorted into oblivion, going bankrupt.
Does it still exist now?
Yeah.
Do you still have your stocks?
I do.
You do?
Yeah.
Is it going well?
It's going all right at the minute. I don't think I've lost any money, but I haven't made any.
Okay.
But
and do you consider yourself an activist shareholder?
For me, it was. Yeah, kind of about activism, but it was also just about fun. Like, it was boring. The middle of 2021, we were all
just a game, actually.
Yeah, we were bored.
And John, how do you look at this? It was a game for them.
Yeah, obviously. I'm not against it, actually. I'm fascinated by it because, as I say, I'm not trying to be careful when I say this. I'm not a basher of Wall Street. I recognize many of the negative elements of it. But one of the negative elements of it is that it's made individuals feel like they absolutely have no ability to participate or understand the system. And I'll say this, it's actually a side effect. I don't think they mean for individuals to feel like they don't understand the system. As I said, it's actually just giant banks fighting each other, and they like to pretend that what they're doing is so complex the other bank can't even do it. So they're they're in this funny kind of a race to be more sophisticated.
But do you think, yeah, this is a bit general, but that those banks realize that there's a whole generation, what we hear now, they feel kind of victimized by the crisis?
Well, that's the thing. They completely wrote off the public. See, remember, so even a big bank looking at a slightly smaller bank thinks that bank is irrelevant now. Like, they can't compete, they're not a player. So obviously, an individual doesn't exist on planet finance. And that's wrong, and it's mistaken, right? So increasingly, we're a consumer society, right? The 80 cents on the dollar is actually coming from buying something from GameStop or buying it from here and so forth. So effectively, the consumer is manipulated to buy certain goods and services. That's classic, right? That's classic way to manage consumption. Here, actually, consumption was redirected and managed from the finance side, right? It's not that people put on Twitter and said, hey, let's go into GameStop and buy some videos to rescue it. They actually rescued the stock directly. And they have the right to do that, right? Everybody knows what they're buying into. And they're saying, I want to do that. Maybe you won't make a profit doing it. Everybody knows that too going in. You knew that going in. You haven't necessarily made a profit, and you're satisfied with your action. So that's direct action by shareholders. That's that's the way the system is supposed to be built.
And do you think this is as rare as a catastrophe, or will this happen more often, Josh?
I think, yeah.
I would be skeptical that it'll ever happen again in that way. Yeah.
Maybe once at least.
No, it was a real watershed moment, I think, and I think that what's going to happen in the coming years is that there'll be a lot more heavy regulation of retail investors. There was a couple of lawsuits that were attempted to be filed, class action suits about basically saying that it was market manipulation, all the people getting together on Reddit. But the key that...
It's the other way around, that you are manipulating the market according to the rule makers.
That was the line that came on CNBC, at least anyway. But the key thing that I think to realize about the community of people who started investing in GameStop is that most of them are not only still in the people that bought initially, that they have bought more, more and more and more, and we can see it because.
And why is that?
Because they believe that they need to own the entire company in order to reveal the fact that. So if you go back to January 2021. There's a measure of how many shares of the company are sold short. So it shouldn't really be more than 100%. But because of the way the financial system and short selling and naked short selling works, it means it can actually be more and more. So there was estimates around the middle of January 2021 that said the short interest was about 280%. So that means for every share that should exist, there was 2.8 in circulation. Yeah, it's hilarious, right?
Well, it's hilarious, but how is that possible?
I mean, I'm not going to, it would take a long time to explain.
Okay.
Basically, you can say it's because of trying to increase liquidity in the market, or you could call it fraud. It depends what perspective you want to look at it from. But the mantra that is evolved online is that people will not sell until someone goes to jail. The phrase is no sell, no sell, no prison cell, no one's going to sell. And it's because, and I think they're right, that they tried to take a stand against all of it was like a symbol for all of the sort of shady, murkier aspects of the financial industry that are this complicated thing that you talk about, that we're made to feel like we're too stupid to understand it. But ultimately, it comes to, it all boils down to me is if you don't own something, you shouldn't be able to sell it. Mm-hmm. So the fact that the financial system operates whereby you can have 2.8 shares for every one that should exist in circulation, that means 1.8 of those have just been sold out of thin air. They've been created by market makers in order to make a profit, and then they've never had to deliver on them because of the way
that makes you angry again, actually.
Yeah, I mean, I want a system, like, I'm not against finance. I'm not against, like, people investing or hedge funds or banks or anything. I would just like the system to operate in a way that doesn't seem like fraud. Like, if I don't own a car, I can't sell it. If I don't have it, if I sold you a car that wasn't really there, like, you'd arrest me. But if it's a stock, it's fine.
Yeah. John, they were trying to tear down hedge funds. Did you feel threatened, or do you feel threatened?
No, I didn't feel threatened by that.
Why are you laughing?
By the way, well, I mean, because it's funny. It's like, people will talk about hedge fund managers as if it's just one person running the whole thing. And I get why. I mean, it's the fault of the industry itself. If you create that mystery, then the public is just going to treat you all the same. So, the industry is too selective about explaining what it does when it's convenient to them, and then being mysterious and not speaking on the record and so on and so forth when it suits them. So they get what they pay. Now, I don't consider myself a hedge fund manager. I don't use leverage. I just do long-only CAT bonds. That's it. But a lot of people like to call me a hedge fund manager. It's fun,
Yeah, it might change the course a little bit, but I was wondering, since you have a hedge fund, also with... yeah, sorry. Yeah,
yeah, it's fine. I don't have a hedge fund.
I know you, yeah. No, I was wondering, the task ahead, what we also saw in the episode, climate change, increase of weather events, what you're actually doing is extremely complicated. All the, the data, the speculations, the simulations, etc. How do you, how do you develop your company? And
Sure. I mean, that's another thing too. I make it very clear to my investors. I don't think what I'm doing is complicated. And I assure them I don't really think of myself as that smart. I'm not stupid, but I'm not that smart. So but it appears complicated to people from the outside, of course. But it really is quite simple. I mean, a lot of the calculations I can do standing in the line at the grocery store. What do I mean by that? It's just that at the grocery store, they used to always have an almanac. It's $4. And the World Almanac, you look at it, it has all these world records and things like that. But it also has all the statistics you need to do this. They actually give you earthquake and hurricane statistics globally, right there, along with sports statistics, everything. So a normal almanac actually has 80% of the information you need to do the calculations we're doing. But the outside world looks at it and they like to imagine a lot of complexity, a lot of difficulty.
Well, on forehand, when we were talking before the program, you told us, for example, about the Turkish earthquakes. You say, yeah, we're relying on data from 1,500 years. Did I hear that right?
Oh, sure. Well, yeah, the Turkish
just a little bit more than a small almanac at the grocery store.
Yeah, but those numbers are actually, you just Google search it and you can see every earthquake in that area going back 1,500 years. So it's like the information's quite transparent, and so there's no real mystery to it.
And what about the other? I think it's a startup company that also speaks about, well, a lot of that data, the historical data, is not necessarily so accurate anymore due to climate change, and then you get the synthetic data sets, I guess. And
sure. Yeah. I mean, we have a climate scientist full time on staff, and she's brilliant. So these things can be done. I'm not saying that it's so simple that every single one of you could be doing this in one day, but it's actually not that difficult. And as I say, the politics of it is that the world makes something more complex than it is because it suits them. It could be and that's not what went on here in this show, which I think is very good. But the media can benefit from making something look more complex than it is. Institutions, insurance companies can make it, this InsurTech startup that you're talking about, I happen to like it a lot, but it's also helpful to make it look like they're doing something really cool that nobody else is doing. But it's really what it is that to the extent that we're doing something new, it's because current institutions don't care. That's all.
Okay,
And to get over the embarrassment, they say, "Oh, they're doing something super complex." It's not. We're just doing something that the institutions don't care.
It's very simple, but maybe there still are some questions.
Yeah. Right.
A few, only a few. Yeah. The microphone is coming your way. Oh, you were first, exactly. Yeah, you were already.
Right.
You must have cramps in your arm.
Yeah, thanks. I had a question on the cat bonds. I like the concept, but what I totally don't get, how can you invest in something that is potentially going wrong, where you would then have to give all your money to and still earn money? Where do you get your interest from?
Well, there's a coupon. There's a rate of interest that we're receiving. Right now, it's extremely high, so it's not normally this way. But we're getting roughly a 15% rate coupon on the bond. By the way, your VOC here in the Netherlands, in Holland, paid an 18% coupon for almost 200 years, every year, faithfully. So, a coupon. It's just so if you invest $100, then you get, in this case, $15 as income every year on your $100
rente
investment.
of dividend.
Yeah.
Dividend or interest?
You can call it a dividend.
Dividend, yeah, dividend.
It's more powerful than a dividend,
But
though.
so
It's guaranteed. It's committed to be paid. A dividend can be
but was
changed.
the VOC handing out the first cat bonds then?
The VOC actually was in my opinion, it was a giant cat bond. It was.
Okay.
They
It was.
insured the
Let-
ships.
yeah,
Can I ask a question really quick? Who's paying that 15%?
Who's paying that 15%? Well, 5% is just the U.S. Treasury. It's the 1-month T-bill. And then the 10% is being paid by insurance companies, reinsurance companies. Actually, Google, the search company, issues catastrophe bonds to protect their office space from earthquakes. Yep.
Yeah, that's the question, because who is basically funding it? That's basically, if you talk about an earthquake in Turkey, are the Turkish people funding it? Is Erdogan funding it?
They are funding it, but so the thing is that the alternative funding is even more costly. So let me use Google or anybody else. It could be a 1 in 1,000 year earthquake, but they have to set money aside now for that, and they can't use that money for anything else, and that's very wasteful. Have you seen the movie Ocean's 11? It's a very amusing movie. So they steal money from a casino. So the casino regulator, the Nevada Gaming Commission, requires a physical dollar in the vault for every dollar of chip that's out on the floor. And there was a big boxing match. So there was 186 million chips. Now, what's the mathematical probability that a casino loses every chip on the floor? It's about 10 to the negative 80. And by the way, there's only 10 to the 80 atoms in the entire universe. So it's very small. But they say, I don't care, it's theoretically possible. So I want a physical dollar in the vault ready to pay for every chip. Insurance is the same way. If it's theoretically possible, they want a dollar in the vault. The rent for that capital and what it could be used for is so high, it makes it beneficial to pay us what they're paying. By the way, ESG, that money in the vault, right now, bonds are being done, catastrophe bonds. They say, oh, great, I don't have to hold that money in the vault. What are they doing with it? They're putting it into green projects. They're using the capital for something that's more beneficial than just sitting there, never being paid out. Sorry.
We're now ending up in a Walt Disney movie with a happy ending. Another question here. Yeah, or the person here, just right next to you, yeah.
Yes, I had a question for John. Currently with cat bonds, there is talked about synthetic models about disasters. For example, with typhoons, you can use historical data or historical forecast data or historical ensemble forecast data and create very big data sets so you can get insight in the outer edges. So my question about this is, how did you take this into account when starting up your company, knowing that these models are also highly flawed? High resolution data is currently always getting updated in grand ensembles and so on. So every 3 or 4 years, you can expect the data that you receive to be better. So how exactly did you manage?
Since the model is in the end artificial, you mean?
Yeah,
Called synthetic?
Yeah,
Yeah.
all models are wrong. So you're bringing. By the way, I don't know how you know that much, but that's a very sophisticated statement about how it's done. So they simulate hurricanes or typhoons that have not occurred, and they actually use a mother-daughter methodology. So typically, we know roughly 1,000 to 2,000 historical hurricanes in any given region, but you really need 200,000, and so they understand that each track. Because a hurricane made landfall in a certain location, they know it could have equally probably done a little bit to the right, a little bit to the left. So they create daughter tracks from the mother track. And using that reasonable approach, you can have synthetic tracks. But the questioner is saying, but still, even that's wrong. And you have climate change, et cetera. So it's true. But let's just be clear, all models are wrong, right? So
Because
like,
it's all in the future.
yeah, I mean, it's a weird process. That's what makes investing interesting. It's like you're a pilot flying an airplane, but you know all your instruments that you're looking at are wrong to a degree. But you still have to fly and you still have to land the plane, and there's passengers, you know, there's children, people you care about. So that's actually part of the practices of investment management, and I'm sure there's some professional investors in here who understand that. Now, having said that, it's still not that difficult. It's actually all, in the end, who plays golf in here? It's hole-in-one insurance. So the probability of a hole-in-one is 1 in 38,000. How do you know that? It's actually just geometry. The balls land on the green, and as you can see, the way I play, it's random when it goes in the hole. So, but you know the width of the hole versus the width of the green, and when you do it on that geometry basis, it actually gives you the right answer. Now, when the fancy model deviates from that answer of randomness, you know it's wrong, actually. So, but climate change will cause it to be a little bit, the ball is a little bit on the left edge than normal. So that alters it a little bit by 30% or so. So there's subtle things, but the basic one is that it's a placement risk. We record 1 million earthquakes across the globe every year, 90 hurricanes across the globe every year. But they don't hit a huge city every year. That city is like a golf hole. So that's how we do it. Yeah.
Okay.
Sorry.
Hello, I was the one who exposed PGGM as one of the investors in CAT bonds in the Netherlands. I work for an industry magazine, and I write a lot about the investments of pension funds.
Okay,
I thought it might be a little bit interesting to share some context of these CAT bond investments of PGGM, which is actually the investor of PSW, the healthcare pension fund in the Netherlands. It's figures from 2018, but it's roughly 4 billion euros in CAT bonds, which is roughly 2% of the total portfolio, which is about 200 billion. They are invested since
2%, you say? 2%?
2% of the whole portfolio, like it's in bonds, in equities, in private equity, and 2% of it is in CAT bonds.
Ja, dit gaat dus over het pensioenfonds PGGM. Kennelijk is 2% van het hele bedrag dat zij bezitten en beleggen geïnvesteerd in CAT bonds.
Yeah, and they invest since 2006. And over the years, and these are figures from 2018, the average yearly return was 7% per year on these specific investments. And actually also the APG, which is the investor of ABP, the civil servant pension funds, invest in CAT bonds. But also pensioenfonds Rail NOV, which is for the train transport
Okay, but your message is clear. There are 4, you said that before, 4 pension funds in Netherlands who are investing in CAT bonds, right? Okay, thank you. Thank you for sharing this information.
Can I respond, because I don't want to get fired for bringing this up. It's like, it's an amazingly defensible strategy. Back to the other questions, like how do you make money when you can lose? So these mandates have lost billions of dollars over the years, right? But they're still diversified portfolios, right? You're not putting everything in one bond. And to illustrate the point, I mean, last year with Hurricane Ian, that's the most expensive insured event in history, right? It's a significant event, and there are many funds, including mine, which were negative. But PGGM, which invests across 30 different people like ourselves and strategies, was positive last year, despite the most expensive hurricane, you know, in history. So they approach it like the VOC. The VOC, when it sent a ship out, is incredibly risky. That ship is almost probably not coming back, right? But the way they manage the risk and they diversify the opportunities, the VOC was able to pay an 18% dividend or coupon every year for almost 200 years, right, despite incredible risk. So in my opinion, that what's going on here in the Netherlands is just an extension of VOC. They recognize that it looks scary, it looks risky, but there's a lot of value in providing the finance in an intelligent way.
We didn't expect this evening would be about us.
Yeah,
It's very interesting. There's another question over there. Nay? No? Yeah. Well, more. Yeah.
Well, as far as I understand the economy as thus far, is that it's like a near zero sum game with all the money that's there. And if there's then a tendency to go towards like a gambling mentality and also profit all the time, how is that then not an immoral question? That's what I'm wondering.
Right. So ours is not a zero-sum game. Insurance is not a zero-sum game. It's just protection.
Zero-sum game means that there's one loser for every winner.
Right. But the stock market trading, day trading, is a zero-sum game. You know, currency trading, day trading is a zero-sum game. But even then, I think it actually can have some value. You know, voting is a zero-sum game in a sense, right? You know, like in our household, it's probably like my wife votes for one candidate and I vote against, you know, so we just cancel out. But it's an important process, isn't it? Right? You know, you can become cynical about why vote? Somebody else is just going to cancel my vote, you know, and you get these amazing contests where somebody out of 50 million votes wins by 1,000. It can make it feel like your vote is being canceled. It's a zero-sum game. But it's an important process, isn't it? We're all turning, it's a democracy. We're turning on our brains, thinking about how the world works and speaking with our vote. That day trading is actually potentially a vote. That's why I think the GameStop story is interesting. As a fundamental investment, it's probably a poor investment. But in terms of the people expressing something, even if it's rage, through that voting process, I think it's very powerful. I don't think it'll be, the GameStop won't be replicated, but I think that the democracy voicing themselves via the stock market will increasingly become common, and it's a very good thing.
And what way will they find? It won't be another GameStop, but in what form will it appear to us?
Can I take that?
Yeah.
So GameStop as a company took all the money that they made off of, well, not all of it, but a lot of the money they made from this and their ability to bring in new talent, and they decided to make an NFT marketplace. Now, NFTs are just the stupid pictures that people buy of things for like half a million dollars, but like the fundamental technology underlying it is really, really interesting, because it's like a digital stamp of ownership. So one of the companies that GameStop partnered with to build this marketplace is called Loopring, and they hold a patent for a decentralized blockchain-based stock market. So the theory goes that GameStop will at some point attempt to exit the stock market and trade themselves solely on a blockchain-based like version of the stock market. Which is said to be
more democratic.
Exactly, more transparent as well.
Transparent and thus maybe democratic.
That's the key, yeah.
Okay, so yeah, they will become from the losers, they will become king.
Quite possibly. I mean, that's just the theory.
Or it's a rumor, yeah. We like these theories. Here's a question.
Yeah.
Hey everyone, thanks for making it right the way to the end of the podcast. I love that you tuned in this long. Do me a favor, hit subscribe, because 80% of you bastards are not subscribing, but you're watching my videos. See you next time.